Welcome back to Real Estate 101. Today we're going to continue our discussion on family law, and we're pleased to be joined by John Schuman of Devry Smith Frank, who's here today to talk to us about property division. John, welcome back to the show.
Good to be back, Joe.
All right, John, so my first question for you today is, when two people get married here in Ontario, does one person automatically have first rights to that other person's stuff?
It's a common misconception, but in Ontario, when people are married, they have a right to sharing the value of each other's property, not the actual property itself. So what's mine is mine, and what's yours is yours still applies. It's just that there's a cash payment from one person to the other to share the value of that property.
To equalize it, I guess.
That's right.
Okay, so here in Ontario, isn't everything split 50-50?
So it's not, the actual assets themselves are not split 50-50, but their value is, and not even their value is split 50-50. It's the growth in their value that is split 50-50. And so what you share when you're married, between you're married and you're divorced, is the growth in your net worth with some exceptions. So you look at what you had at the beginning of the marriage and what you had at the end of the marriage, and you share in that growth.
All right, so let's talk about some of these exceptions. What would a court look upon when looking at these exceptions in a marriage?
Well, the first big exception is gifts or inheritance. So if you inherit something from a great uncle or something during the marriage,
right,
you don't share that when you're sharing the growth in your net worth. That sort of gets put to the side and it's separate. The other thing you don't share is a personal injury settlement that's related to the pain and suffering. The actual loss of income and other sort of claims you may have to share, but not the pain and suffering part of a personal injury settlement. You can also not share things that you specifically agree you won't share in a marriage contract. So you can leave stuff out or adjust the way things are divided in a marriage contract.
And this is done, obviously, when you're doing the marriage contract beforehand.
That's right.
So whatever's set out in there is what the court would I guess, enforce.
Yeah, a lot of people like to opt out of this particular way of dividing property. And so the marriage contract, you can recreate the way you divide your things when you separate.
Okay, John, so are there any exclusions? And if there are any of them guaranteed? So
you can exclude things out of your inheritance are excluded, and the personal injury settlement portions of them are excluded, and you can exclude things as in a marriage contract. But are any of those guaranteed? Well, there's some big exceptions that keep things from being excluded.
Right.
The first is matrimonial homes. If you take any money you have that is otherwise excluded and put it into a matrimonial home, then it's shared, because you always share the full value of your matrimonial home on separation, regardless. Right. So unless you have a marriage contract that gets out of that, any money you put into a matrimonial home, you're sharing with your spouse, guaranteed. Less guaranteed is that if you put things into a joint asset. So if you put something into like your inheritance into a joint bank account, then the presumption is that it's now a joint asset and it's shared equally. And so you lose the exclusion. There are some complicated rules about trying to trace the inheritances and other types of money through those, but you shouldn't rely on them because it's a really complicated exercise, costs lots of money, and it's not guaranteed in the end. And with the other thing is that there can be an adjustment because the unequal division would be unconscionable.
Right.
But that is a really exceptional remedy. It is only used when a judge thinks that the dividing things equally would be shocking to the community's conscience. So we're talking about, as shocking as some of those terrible things you see on the news,
right,
and the horrible things people do and child molesters. That's the type of unconscionability you're talking about to have an unequal division. So you shouldn't rely on that except in really exceptional circumstances.
And I guess in something like that, maybe they're looking out, they don't want to set a precedent either, right?
Yeah, that's right. And it's the judge deciding it's not going to be an equal division of the growth of net worth. That is a really exceptional thing that a judge does, and only where it's clearly going to shock people that was still done.
All right. So how are things divided up?
So we don't actually usually divide up the things themselves, but what we do is we do a calculation, and we look at what you had on the day you were married and what you had on the day you separated, and you take one from the other, so you get the growth in your net worth.
Right.
you take out of that calculation, I said all those exclusions, but basically that's the calculation you do. And the lawyer for your spouse does the other side. So your spouse's lawyer looks at what they had on the date of marriage and what they had on the date of separation, takes one from the other and comes up with a number. The number we come up with is in legal terms called net family property, but all that means is the growth in your net worth. And after that happens, the person who had the bigger growth in their net worth has to make a payment to the other spouse to make the growth in net worth equal, subject to those exceptions. But so what you have is, at the end of the marriage, both spouses having an equal growth in their net worth during the marriage, and that's how property value is divided in Ontario.
Okay, so I want to touch a little bit on pensions, because I know, some of the cases I've heard, I know pensions are often brought into, divorce matters. So how do the pensions work?
So the first thing you have to realize, there's two types of pensions, and one is called a defined contribution plan, and that's basically an RRSP. So that's not really that complicated. You divide it subject to some taking the tax off that you owe at the end of the day. Defined benefit pensions are the ones that you hear about that everyone really loves, because that's where you're guaranteed a certain amount paid for life, and those are very valuable assets because you have a fixed amount you're getting paid for from the day you retire to the day you die, basically. And if you think about it, if you're one of those people who's lucky enough to have a pension that, say, pays you $4,000 a month or $48,000 a year, which is not a lot for some pension plans, from the day you retire, over the course of 20 years, that's 240 months, that's going to be worth $1 million in payments.
Wow.
So that pension can be worth $1 million. And that is a huge asset to be divided. And in Ontario, it's property to be divided. So it can cause some real problems for someone who has $1 million pension on their side and nothing else.
All right. So how can someone who doesn't have very much other than their pension afford to make a payment for $500,000?
Well, most people can't. So they changed the law in Ontario a few years ago, so you can actually divide the pension itself. So what that means is, if a judge agrees or you and your spouse agree, instead of paying your spouse that $500,000, you transfer part of your pension into either their pension plan or into a locked-in retirement account. And that way they have sort of half your pension when they retire, and you still have half your pension, or another number. You don't have to be equal, but it's some amount of the pension. So your pension goes down in how much you get. Their pension goes up in what they get, but you don't have to make this big payment right away.
Okay, so who presents these numbers to, the ex-partners, spouses, ex-husband, wife? Who presents these numbers to them, and how do they know that these numbers are correct and are accurate?
Well, at some point, you and your spouse, when you separate, have to come up with show what all you have, all your assets and all your liabilities.
Right.
And usually when you do it to the lawyer, you do it on a calculation sheet called a net family property worksheet. But if you're just going to put it together and you're going to show your spouse, these are the values of everything I have, and this is how much I have to share with you, and your spouse should do the same, you can do the calculation. The way you know that's correct is that for any domestic contract, including separation agreements, you have to do financial disclosure. And if you go to court, you are required to do a financial disclosure now at the very beginning. And what that means is, for every number you put on that sheet, you have to give a backup document. So if you say you have an account with $5,000 in it, you have to have a bank statement that shows here's the account with $500.
Something to substantiate it.
That's right. And that's how you know it works out. Now with pensions, it's a little bit simpler because the government has set out a formula that your pension provider has to do. So if you have a pension, you send in the forms, you pay $600 to your pension provider, and they give you back a number, and that's the number everyone uses. It's an agreed upon number. There's nothing to fight about.
All right.
But for bank accounts, there's usually nothing to fight about because you have a number there on the page.
Okay, so for couples that have been together for a very long time, obviously it's going to be difficult for everybody to have every single document. If you've been married 20 years, doesn't it become difficult to substantiate, or how do they substantiate something from 20 years ago?
It can be difficult to substantiate, and if you don't have the proof of that you had that thing 20 years ago, then you don't get to claim a deduction. You don't get included in the calculation, so you don't get to show that was part of your net worth at the beginning of the day. So you really do have to find the documents or something that shows that you had that asset at that time, so you can claim that deduction from your net worth.
Okay, so what happens in the case of separation? Let's say a couple separated years ago, and now they're just going through the legal process. What happens then?
Well, there's a bit of a catch for doing that, and this is why you can't wait forever to see a lawyer after you separate, and that is because there is a limitation period for how long you can claim a equalization payment. That limitation period is one of 3 times, but the longest it can be is 6 years. So you'll always have the bank statements and things available because banks keep things for 7 years.
Yeah.
So, but the limitation period is you can claim this equalization payment for 6 years after the date you separated. After you've been separated for 6 years, if you haven't claimed it, then you're out of luck. And if you've got a divorce, so you and your spouse divorced but did not get to do the property division aspect of it, then you've got 2 years from the date of divorce. So only 2 years from the date a judge says you're no longer married to do this calculation. Once that's done, it's done. You can't do it anymore. And if you're unfortunate enough and your spouse dies, then you've only got 6 months from the date of their death to claim an equalization payment.
All right, John. So any last tips for somebody who's going through a separation or a divorce that doesn't know much about property division?
Well, when you separate, you should try to get as many of your documents together to show what you had on that date so you can find them, and whatever you had on the day you got married, so you have the documents to back up your position. And if you don't have backup documentation, or you can look for your spouse too, obviously.
Right.
And if you don't have backup documentation, if you've got more complicated assets to value, then you really need to speak to a lawyer about how to do that. So you've got a business or some jewelry or something that's difficult to value, then you need to speak property. Then you need to speak to someone about how to get that valued and to do it properly so you don't get, taken advantage of in the process. And if you weren't actually married, if you were common law, then these rules don't apply to you. So you really need to speak to a lawyer because you can be in real big trouble about where all the money went during your relationship if you're common law, if you didn't set things up properly. So you really need to speak to a lawyer in that situation as well.
All right, John. So if somebody is watching our show or listening and they want to get in touch with you to help them out, maybe they're going through a separation or divorce, how do they get in touch with you?
Well, they can call me at 416-446-5080. That's my direct line. I have a website, which is www.devrylaw.ca, or you can email me at john.schuman@devrylaw.ca. All those get me quickly.
All right, John, great stuff. Thanks for coming on today's show.
Thanks for having me, Joe.
So there you have it. If you're looking to get in touch with a top family lawyer, get in contact with John Schuman. Don't forget to like, comment, and share our videos. Subscribe to our YouTube channel. I'm Joe. Thanks for watching, and we'll see you next time.